marking a possible reset in relations following last month's ramping up of tariffs by the United States. And Indian automakers announcing price cuts as they respond to the GST changes. We'll hear from some of the biggest players in the market later on in the show. Good morning, and we start off this Friday with another look at how Asian markets are shaping up across the broader Asia-Pacific region, and smiles to be seen across most markets with shoots of green really showing up. We're seeing the Nikkei 225 testing another record high today. They're up by about 0.7%, and again, a lot of this optimism also being fed by the possibility of a rate cut now rising even more in the United States. And that's feeding equity valuations. As we mentioned, the Nikkei 225 in Tokyo now at another record high today. Even the Shanghai Composite is all smiles, up by about 0.1% so far. In the Hang Seng, at least in Hong Kong, we're also seeing the Hang Seng Tech Index seeing better than the gains than usual, actually, with a lot of the tech plays in Hong Kong also seeing good intraday gains so far this Friday morning. And the Indian markets are set to come online in about 45 minutes, a day after they breached that 25,000 point mark, that is. Here's what GIFT Nifty futures are now showing us. We're seeing that it is foreshadowing an 8th straight days of possible gains today, and again 184 points above yesterday's close. But contrasting fortunes actually with the rupee today weakening, possibly weakening once again. Keep in mind that the rupee did hit its weakest levels on record just the other day. So weakness in the forex space being offset, it seems, by some strength, and cautious strength at that, in the equity space for Indian markets. And starting with trade, the U.S. is reaching out to its partners to put more pressure on India and China over Russian oil purchases. According to the FT, the U.S. is asking all G7 countries to impose higher tariffs on the two nations. The move is set to be discussed by finance ministers in a video call later on today, and comes days after it urged the EU to hit India and China with 100% tariffs. U.S. Commerce Secretary Howard Lutnick discussed India's Russian oil purchases with our U.S. colleagues overnight. Here's what he said.
We're going to sort out India. You know, India basically has to open their market, has to stop buying Russian oil. You know, people don't remember, India didn't buy Russian oil before the war with Russia and Ukraine. They had 1% of their oil was from Russia. And now 40% of their oil is from Russia because we've sanctioned it so they can buy it, $7, $10 a barrel cheap. So they're buying it, refining it, and then selling it to the rest of the world and making a bundle. So the president called nonsense on that and said, you got to stop that stuff. So I think India will sort it out once they stop buying Russian oil.
And sanctions on tankers carrying Russian oil could hurt some of India's biggest refiners. The country's largest private port operator, the Adani Group, reportedly barring tankers under Western sanctions from docking at any of its ports. The move could disrupt Russian oil shipments to two Indian refiners, including HPCL Mittal Energy and Indian Oil, which both brings cargoes through Adani's Mundra port in Gujarat. India remains the top buyer of Russian seaborne oil, but Adani says sanctioned vessels will no longer be accepted, citing legal and commercial risks. The Adani Group and both the refiners did not immediately comment on the report. And staying with trade, Donald Trump's nominee for ambassador to India said the two countries are, quote, not that far apart on the deal when it comes to tariffs. At a Senate hearing, U.S. Secretary of State Marco Rubio introduced the nominee, Sergio Gore, and said that India is one of the top relationships the U.S. has. The comments mark a change in attitude on relations following a breakdown in trade negotiations last month after the United States decided to double tariffs on India. Amid that mixed messaging from Washington, India is ramping up other trade negotiations. A European Union delegation is in New Delhi through Sunday, pushing talks on a free trade agreement both sides want wrapped up by the end of this year. The two sides are reportedly making progress on issues like electric vehicles and farm goods. India is also hoping to secure tariff relief on some of its labor-intensive exports, including textiles, gems and jewelry, and engineering products. Commerce Minister Piyush Goyal also says a second trade pact with Australia will be finalized soon, and a deal with Oman could follow in the coming weeks. Well, Sumedha Dasgupta is a senior analyst at Economist Intelligence Unit, and she specializes and focuses on trade. Here to talk about why some of these trade deals for India are going to be tantamount and important for the country as they try to navigate a lot of these other economic uncertainties that are coming from offshore. Sumedha, thank you so much for joining today. Let's start off with the trade deal that India and the EU are trying to hammer out. How important is this trade deal going to be for both the country and the European bloc?
Thank you so much. Well, certainly, as you've nailed it, it's very, very important. Both sides have been trying, first of all, to get this trade deal done. And other than that, the EU has also been frantically trying to get other trade deals done, for example, with Mexico recently, the Mercosur countries. It's also negotiating with Indonesia, with the UAE, along with India, of course. India itself has been kind of shedding its protectionist stance and generally notching up trade deals quite fast. As you mentioned, yes, Australia, there's been UK this year itself, EU, which is possibly likely before the end of this year. So certainly both countries have a ton of skin in the game, given that dynamics are changing very fast with the US, in order to be able to secure and insulate their trade sectors from the kind of terrible global trade slowdown which could come about from these tariffs.
So, Medha, how quickly can these FTAs be hammered out? Because I'm under the impression, based on other free trade agreements we've seen in the world, that these things take some time, actually. Is achieving this free trade agreement between the EU and India realistic? Is it, I mean, the goal of achieving this by the end of the year, is that a realistic goal?
Well, you're absolutely correct. Usually trade deals take years and years. For example, the one that India did with the European Free Trade Association in March of last year, that took a clean 16 years to actually iron out. And trade deals are generally something where you have to do a lot of discussion on give and take. So usually you have a very, very long period of time in which the deal will be negotiated. If the countries are in a hurry, usually what happens is some form of an early harvest deal comes and difficult things are left for discussions later on, which will come in the form of full form trade deal. For example, the one with Australia, there's a initial form trade deal at this point of time and a greater form trade deal that's going to come in later. But what's kind of changed at this point, which we have to remember, is the global context. The global context isn't as sure or as certain anymore as it was even, say, a year ago. And at that point, countries were kind of doing it slowly, dragging their feet, having discussions, having arguments on what should be given, what should be taken in a trade deal. But right now, given the terrible uncertainty in the global trading scenario, especially brought about by the US, it's very important for all these countries to kind of ink trade deals as fast as possible. Having said that, these are not really the back of envelope or napkin kind of trade deals which, say, the US has inked with a lot of countries, say in Southeast Asia or even the EU. These are more tangible trade deals, actually, but it is also likely that a lot of the contentious issues could be shifted to the back burner. Countries will be willing to give in on a lot of these issues, which they were not in the past, just for the sake of kind of getting an agreement and, as I said, insulating their economies. That's most important.
So it seems there's been some progress made with regards to inking this trade deal between India and the EU. But one sticking point that comes to mind really is that of Russian crude oil. In fact, if I'm not mistaken, the EU has also sanctioned Indian petroleum exports because this is primarily built off of or built off of refined Russian crude that comes into India. It seems like it's very targeted towards some of these Russian crude imports that are coming to India that some say are actually fueling that war. Again, how big of a sticking point is this going to be? Because we've seen that it's been difficult for India to budge on weaning itself off of Russian crude because of how difficult it is.
Yes, certainly. So a couple of things have to be kept in mind. First of all, India has been buying Russian crude oil well within the global price cap. The global price cap has been set by the West, in fact. So it's not actually flouting any global conventions in its purchase of Russian crude oil. Second, India is a major energy importer and requires that energy should be purchased competitively for its fiscal, its balance of payments needs, its inflation needs. Obviously, that is a very important thing for India to secure. So, which is the reason why India is kind of being so intransigent on giving up on Russian crude oil purchases. And these refined petroleum products from the crude oil that is purchased from Russia is actually a lot of it is going to the US and the EU. So while I don't really think that this is going to be kind of a leading point in negotiations, because I think by now it's very clear to many countries, especially the US and the EU, that India will not give up on these Russian crude oil purchases, even though it may maybe reduce the quantity a little bit, but certainly India is not moving away from Russia in any meaningful amount, at least in the near future. So definitely, I think they're going to sort of cast that issue aside when they're working out the trade deal. But where that issue may actually come up is because the FTA needs ratification in the European Parliament. Now, if that is an issue with the broader EU, then that means that beyond the trade negotiators and their talks, this is something that could potentially build resistance against the FTA in the EU Parliament. That will, of course, need to be seen, and it all depends again on the extent of disruption to global trade by that point of time. But I don't think in the negotiations, at least, this is going to be kind of a breaking point, or that the EU is going to kind of want to follow what things the US President Donald Trump wants the EU to do. So I think that that's really very unlikely.
Samita, since we bring up the idea of Indian petroleum exports, can you give us an idea of how big this industry is in India, and how many jobs, or how much in terms of monetary impact will there be if, say, sanctions on these petroleum exports that are based somewhat on Russian crude do take into effect in a worst-case scenario? Just how big is the petroleum export industry, petroleum goods export industry in India right now?
Sure. So just for some numbers, India basically purchases more than 80% of its crude oil needs, and it re-exports in the form of refined petroleum products, a little above half of that. Most of that goes, as I said, to the Western countries. A lot of it, of course, goes to the ASEAN nations also. Now, the point about this is India has emerged very recently, in fact, just over the last couple of years, as a very sort of prominent refined petroleum product exporter. This is mostly because India has, first of all, diversified its basis for importing crude oil. So there's like a lot more volume coming in at this point of time, which is refined. And India has also done over 2021 and 2022 substantial upgrade of its refineries. So earlier, Indian refineries were not, for example, equipped to refine crude petroleum that's coming in from, say, Guyana or from Nigeria or from Russia. Russia has Ural-grade crude. India earlier would just sort of restrict itself to the Oman-Dubai Brent-grade crude. So obviously, there's a ton of investment that's gone into upgrading these refineries, and India would want that investment should not be for naught. And certainly, as a result of that, India will continue to purchase crude oil from a lot of sources, which also includes Russia. Of course, refineries, they generate a significant amount of jobs, so there is an employment aspect to it, though I would not say it is to the extent of the employment aspect that is maybe important for, say, agriculture or gems and jewelry or textiles, those kind of industries. But yes, of course, there is a significant employment aspect as well. So, which is kind of the reason that because India has developed this capacity or this potential, that India wants to maintain it, definitely, irrespective of kind of what kind of pressures come on it from Western nations. So I feel that this is a capability that India will actually continue to maintain even in the years ahead.
So, Mehta, let's talk about where this pressure to wean India off of Russian oil is coming from. And it's clearly coming from Washington, D.C., which, again, has its own set of issues with regards to India trying to ink a free trade deal and avoid those higher tariffs. There's been a lot of mixed messaging, it seems. On one hand, they say that they're close to actually achieving a trade deal. Then you hear from the likes of Howard Lutnick or Peter Navarro, who go as far as to call India the Maharaja of tariffs, which some say might actually be an unfair label. Talk to us about the mixed messaging that we're seeing here. How is this making it harder to accomplish a possible trade deal with the United States? Or is this just a negotiating tactic that both sides are aware of?
Well, Well, I think the US administration under President Donald Trump kind of uses uncertainty as a currency more than anything else. So the mixed messaging is also kind of to keep markets, to keep other countries with whom they are negotiating trade deals on edge. It is with the effect of sending geopolitical messages to India, to Russia, to China. So you have to remember that this mixed messaging is actually not recent. It's started as far back as February when the Indian Prime Minister went to visit the US President. And since then, it's just been a continuous whipsawing. Yes, initially there was some progress on trade deal. However, with all this sudden talk of Russian crude oil, which again is not new because this is something that the US knew very well where the crude oil was coming from. So this is again a manifestation of the Russian president's constant frustration of the efforts of the US president to end the war. So there are many other convoluted angles to all of this. And of course, the recent messaging that's coming in that we are still in trade talks and, we are close friends, these kind of things from the US is more sort of a recognition of the SCO kind of bonhomie that we saw among India, China, and Russia. So I would say, of course, a trade deal is still in the works. Both countries are huge markets, and a complete decoupling is something that neither of the two countries would want. So certainly both sides would still be working very hard. But the problem is that because of the punitive nature of tariffs, there has been some souring of sentiment, which also has to be kept in mind, which will potentially kind of weigh on trade talks also. And another thing to remember here is that the kind of arm twisting that the US administration is doing to a lot of countries, not just India. It's been very successful with a lot of, say, Southeast Asian countries who have quickly jumped and taken trade deals, whatever deals that they could. This is really not working with India because the kind of agricultural market access that the US wants is not coming from India. The punitive tariffs are more actually a reflection of that than actually a reflection of what Trump wishes to accomplish with Russia. But again, this is something that's a red line for India. So the kind of market access that US wants, India will not be able to give. There will, of course, as I mentioned, it's a trade deal. There will be give and take. But because there is significant disagreement on that, this is likely to be a very long-winded process for both sides.
And one more thing that might complicate things right now, Sumedha, is the proposed services tax bill in the United States. Now, we've only covered goods trades, the trade of goods right now between India and the U.S., but this might be even more concerning, actually, from India because of the size and the impact on the IT and BPO industry there. Now, the bill is still being deliberated in the U.S. Congress, but if this does come to pass, would this be an even bigger headache for India than the tariffs on goods because of the impact on some of these burgeoning sectors in India?
Yes, I believe you're absolutely right. In fact, the impact of tariffs, punitive or not, on trade in goods is actually quite not that significant for India because India has a lot of buffers. It's not as export dependent for goods as, say, Southeast Asia or China is. So that way, India's economy is generally insulated, even if punitive tariffs are there as far as 50%. But yes, if there is a taxation on services, much of India's services exports, India is, of course, a global leader in service exports. Much of these go to the US. This actually has the potential to bring about much more of a shock. This is also trade, so much more of a trade shock. For India, this will be quite bad for, especially even while the bill is being deliberated, quite bad for new deals, quite bad for a lot of IT giants Indian IT giants who are based there. So obviously, this is going to be a tremendous shock. We were so far factoring in services trade as actually a buffer, which would work against, which would work to insulate the economy against all these merchandise trade headwinds which are coming in. But if this bill does get passed, becomes a reality, and kind of say we see the impact of it next year, then in that case we can factor in a much greater slowdown because I don't think there is that much ease of kind of navigating away to other markets for services exports. And this is an area where India has kind of been relying quite hugely on the US. And this is a developed market trade that's been happening for a very, very long time. So yes, this is potentially quite a big shock.
And yet another thing that India might have to tackle down the road, but we'll have to leave our conversation there. Sumedha Das Gupta from Economist Intelligence Unit, thank you so much for joining today and appreciate your insights on this very pressing matter that involves and might provide headwinds to the Indian economy. Coming up, Japan-U.S. ties in focus as U.S. Commerce Secretary Howard Lutnick spills more details about their pact. Details on the other side of this break. Don't go away. Welcome back. You are watching Inside India, and some of the stories we're keeping tabs of outside of India. Brazil's former President Jair Bolsonaro has been sentenced to more than 27 years of jail after being convicted of plotting a coup to remain in power after he lost the 2022 election. He becomes the first former Brazilian president to be convicted for attacking the country's democracy. U.S. President Donald Trump, who previously called the trial a witch hunt, has condemned the decision, saying it is very bad for Brazil. Utah officials releasing footage of the suspected Charlie Kirk shooter a short time ago. CCTV images shows him climbing off a roof and fleeing the scene. This comes after federal law enforcement shared images of the person of interest. Kirk was the co-founder of Turning Point USA and a staunch supporter of President Trump. At a 9/11 memorial event at the Pentagon overnight, Trump said he will honor the conservative influencer posthumously with the nation's highest civilian award, the Medal of Freedom. And more than 300 South Korean workers arrested during an immigration raid at a U.S. Hyundai plant after finally heading home. Hyundai Motor CEO Jose Munoz making his first public comments on the issue, saying it could delay the plant's startup by at least 2 to 3 months. U.S. Commerce Secretary Howard Lutnick also weighed in, telling CNBC the Trump administration is working to address future visa issues. And U.S. Commerce Secretary Howard Lutnick also talked about the Trump administration's deal with Japan in an interview with our colleagues in the United States. And Lin has more details. Go ahead, Lin. Tell us more about what's been happening and what more about this trade pact that's been inked by the two countries.
Yeah, indeed. So it's the executive order on the one hand and this MOU, which relates to this massive $550 billion investment fund. And we got more details about how it will work in practice here from the Commerce Secretary Howard Lutnick. Let's watch.
There's an investment committee. We suggest projects. Let's say the Alaska LNG pipeline. We want to invest $100 billion and finally unleash the American oil and natural gas that we have in Alaska. $100 billion project. The president green lights it. We hire the construction people. and we send a capital call to the Japanese. They send in the money. We build the pipeline, and when the cash flow starts, we share the cash flow, the United States of America and the government of Japan, 50-50 until they get their money back. So when they get their $550 billion, you know the United States of America only made $550 billion, and then after that, it's 90-10 in favor of America.
And JP, as you can imagine, this is a pretty novel concept, and certainly you've got other nations, particularly South Korea, that is watching this very, very closely. It is essentially, when you look at the full package, the price to pay, right, for the lower tariffs that Japan was able to score in its trade deal with the United States. When we think about the parameters here, and we've talked about this, effectively it means that the US president can direct Japanese capital, albeit he can take that advice from a committee that sits below him, although the committee is made up solely of US representatives who then may consult another committee that is made up of officials from both sides. And also, if Japan decides that they don't want to agree to fund a particular project here, it could mean a snapback of those higher tariffs. Certainly, this would not have gone down unnoticed in Tokyo. We expect that today, Ryosei Akazawa would be meeting with the Upper House Budget Committee to talk about the enactment of the executive order and perhaps around the investment fund as well. Separately, one other update that we did get was in relation to the Forex space, with Scott Bessent as well as the Finance Minister Kato releasing a joint statement. It basically set out the status quo of what already exists here. But I think what's really worth noting is the fact that the statement did not require Japan to do anything else. Because remember back at the beginning in April, when the two sides started to negotiate, there was this question mark around how Forex would play into the deal, right? Because the US president has long been talking about the fact that he feels the Japanese yen is too weak and that is affecting the competitiveness of US manufacturers. So that is not part of any kind of new statement. Although you could argue, though, some of the comments that we have heard from the Treasury Department in the US with that report, Scott Bessent making those comments as well, that Japan is behind the curve, that jawboning maybe has already done some of the work there as well.
A lot of things to really parse, but very interesting details behind that pact that are important for us to understand. Lynn, thank you so much for walking us through that, actually. And coming up, gold prices hovering around record highs, and we will find out why investors are flocking to the precious metal. We'll be back in a bit. Welcome back. And let's take a quick look at U.S. Treasury yields and where they're trending right now. We're seeing that there is a notable uptick actually in a lot of these bond yields. The 10-year now up to about 4.0339%. And the 10-year did briefly drop below 4% for the first time since April as investors digest the latest sticker price and jobless claims data. August CPI climbed 2.9% on year, largely in line with the forecasts. But weekly jobless claims jumped more than expected, marking the highest level in nearly 4 years. The push and pull factors, which could signal stagflation, is complicating the Fed's job. David Rubenstein from the Carlyle Group telling CNBC why a bigger than 25 basis point rate cut could be alarming.
The Fed next week will obviously do something we all expect. I don't think it's going to be a surprise.
You think it's 25 basis points or 50 basis points?
It'd have to be 25 basis points. If the Fed were to go 50 basis points, it would scare the markets that the economy is weaker than the market thinks it is. And I think it would be too much for the market to absorb.
And we are counting down to the market open in India, but 14 minutes away. This is how we're shaping up. And according to GIFT Nifty Futures, we're now seeing that it is foreshadowing a further breach or an extension of that breach of 25,000 that it accomplished just the other day. 25,169 for GIFT Nifty Futures sit about 164 points above Thursday's close. But in contrast, we mentioned while there is flexing in the equity market, there's a bit of softening in the FX space. We're seeing the Indian rupee now once again touching new record lows or record week levels actually. 88.40 is where the local currency is, and its previous weakest on record was about 88.33. So that's a significant weakening actually for the local currency, and we'll see if this trend holds up as the trading session or the last trading day of the week progresses. And we're also going to get in August inflation data later this evening, with headline CPI expected to rise from 1.55% to 2.1%. Possibly ending a 9-month streak of declines. Analysts say the base effect started to fade in August and that food prices are picking back up. Despite the uptick, inflation is expected to stay below the RBI's medium-term target of about 4%. And all of these macro factors playing a part in the precious metal moving from strength to strength. Gold is looking like this at the moment, and again, continuing its upward march, and it's probably the most confident asset class in the commodity space so far this year. 3,650 is where it sits, and also looking to test new record highs as well. Indian investors, too, have been piling in, preferring gold over equities, leading to ETF flows hitting a 7-month high in August. Well, Pranav Mer is the Vice President of Commodity Research at JM Financial Services. He joins us to make more sense, actually, of this very, very strong year and this very good year for the precious metal gold. Pranav, thank you so much for joining us. Before we get into the dynamics of India and its very close relationship, actually, with gold, I do want to talk about the overall rally for gold prices. And we talked about the possibility of higher jobless claims in the United States and also a possible rate cut out there. What kind of upside, if any, or additional upside could a rate cut in the U.S. perhaps provide where gold spot prices head from here on out?
Looking at the current price dynamics, where the gold has been going on, we are already pricing in a 25 basis point of a rate cut from the US Fed next week. So any surprises of a 50 basis point cut or an unchanged decision could bring in some more volatility into the gold prices. If we see a 50 basis point cut, gold could see a further uptick, and we could see prices scaling past $37.50, move close to $3800 levels as well in the near term. But if we see over the recent rally that we have seen in gold prices after it has given us a breakout above $3,500, we may continue to maintain a positive view, but advised a little bit of a cautious as some profit taking could come into the gold prices, and those corrective moves should be a buying opportunity at lower levels in the near term.
Pranav, are you surprised at how sturdy gold's rally has been this year? Because we have seen some moments of profit taking. We've also seen some moments where sentiment, risk-on sentiment was back on. And despite the fact that there was confidence in some instances this year, gold has been quite steady in its upward march. Are you as surprised that gold has seemed to moved higher, whether it's risk-on or risk-off in the broader markets?
Yes, it was a little bit of a surprise. We were expecting a return of 15 to 17%, so in the current year 2025, but the return has more than doubled. We have seen a 40% return in the domestic markets. The return in the international is close to 40%. The major key trigger that has pushed the gold prices higher has been the central bank has been continuously adding to the reserves. We have seen ETF investors have been getting more interested into the gold, be it in the Asia, be it in the America or the Europe. Everywhere we have seen inflows continues to go into the ETFs, and the derivatives of gold has been adding further fueling upside. There are reports coming in that many pension funds have been allowed to invest in gold. So diversification into the gold has pushed the prices higher. We have already seen dollar index witnessing a significant correction in year till date basis. So that is another trigger that has been pushing up the gold prices. Many countries are diversifying the reserves. There have been talks of de-dollarization, although it's still far away. At current levels, but many countries are trying to shift their trades into local currencies. So all these factors is seen keeping the gold prices up, fueling the precious metals upward rally.
So, Pranav, before we go into the long love story of India and gold, I want to talk about the RBI specifically, because it has been also reported that over the last couple of years, they've actually been steadily paring back on their holdings of U.S. Treasuries and leaning more into stockpiling or boosting their gold reserves. How significant are these moves by banks like the RBI in terms of providing that upside that we've seen benefit gold in the last couple of months?
Looking at the diversification, what has been coming in, this diversification across central banks, not only RBI, across the global central banks, it has started since 2022 after the Russia-Ukraine war that started, and the Russian assets were free. So most of the central banks have started adding gold to those reserves. We have seen some strong additions coming in 22, 23, 24. This year, the additions have been a little bit on the slower side. If you see, just 4.5 to 5 tons have been added so far this year. But overall, if we see, the holdings have gone up. The share of percentage share of holdings, which was around 7 to 8% previously, it has risen close to 12%. Now we expect to continue this. Most of the central banks, including RBI, we expect them to at least bring their reserves in between 15 to 20% over a period of time. It may not be this year, maybe in a couple of years or in the next 5 years timeline. But yes, the gold is likely to go into the reserves of the central banks as a part of their would be the major component as a part of their FX reserves.
Pranav, it's not just the central banks of the world that seem to be favoring gold. And as we noted earlier on before the interview, even Indian investors are doing that. While the Nifty 50 has been on an upward march, domestic investors in India seem to be moving away from equities and increasing their holdings with regards to gold as an investment. I think the question really here is, should we be a bit concerned about a risk aversion trend that's being exhibited by Indian retail investors right now? And is that a hallmark or perhaps a warning sign of more risk aversion and worry for broader investors and with regards to the direction of the global economy?
The love for gold and Indian investors has been a traditional, it has been going on for over decades, over multiple years. So at any price, the investors are always ready to put up gold. There has been increased attraction into the gold price because of the gold derivatives that has been come out, that is in terms of ETFs, the exchange traded funds. Yes, definitely current prices, we don't advise our investors to put in money at this price. We are advising them to at least wait for a correction of at least 7 to 8% from current price levels before starting to initiate fresh positions. But why the money has been flowing in? Because ETFs gives them an opportunity to buy in even in small quantities, accumulate at every depth in months. So that is why we have seen increased inflows into the ETFs. Adding to that, although the equity markets are at close to record highs or have been doing steady performance on a year-on-year basis, but there has been a trend of diversification. There have been trends that earlier we used to have the bigger investors used to diversify. Now even small investors are adding gold to their portfolio in terms of ETFs, even if they are unable to buy from the physical market, but they are accumulating online through ETFs or any other derivatives of gold.
Pranav, let's dig deeper into this, as we've coined it, for lack of a better term, this long love story between India and gold. And it's no surprise to anybody that India is one of the biggest demand drivers for gold in the world alongside China. Help us understand these demand dynamics in India. Is this more retail demand from retail buyers of physical gold and investments, or is this an institutional demand driver more when you assess the factors that influence and shape gold demand in India?
Looking at the current price levels, where the prices have been going, the retail demand is little bit on the weaker side. We have festive season coming ahead, that is Dussehra towards the end of the month and Diwali next month. At current price levels, the retail investors are a little bit cautious in buying. Yes, there has been the institutional demand. Institutional demand comes in from the ETFs, the fund houses, which has been putting in their money. So here, where the retail investor has shifted towards the ETFs or the other instruments rather than buying it physically, as they need to pay some taxes, need to keep a store in value. But ETF, they purchase it online. They can liquidate anytime they want. Even they can keep it in the demat form. So that is why there has been a shift from physical demand to the institutions, like where the retail investors put in their money and then the institutions keep purchasing gold and get it listed on the exchanges.
Pranav, how much of this is also perhaps down to a generational shift as more Indians or younger Indian generations perhaps become more comfortable with purchasing ETFs or even purchasing things in the digital space? Is this also perhaps a signal, a sign of perhaps a shifting trend as to how Indians access or satiate their gold demand?
Possibly, yes, could be a situation where the young generations are looking gold as an investment class or as an we can say a revenue generating the asset. But traditionally, those who used to buy gold in the physical form and keep it in house, there has been many schemes that has been going on in the markets where people pledge their golds, existing golds, and take a loan on that. So there has been multiple avenues, but yes, there has been a slow and steady shift in the thinking of the, rather than keeping gold physically at home or in the bank locker, people have started buying, putting in their money into the ETFs, which generally gives the similar returns. There may be a difference of 1 or 2%, but generally gives the similar returns as the gold gives or as any other asset class gives.
So Pranav, as you alluded to a while ago, the festive season is coming up, and this GST reform has really boosted the demand for a lot of consumer goods in India. And this is also a time when people expect that the demand for gold actually rises. How critical is this time for gold buying in India, and what can we expect, especially given all of the reforms that might reshape our expectations during this very consumer-heavy season?
The recent reforms that have been announced by the government, we may not see an immediate impact. Over a period of time, we may see that impact on gold prices. But yes, the festive demand is there. Both the occasions, Diwali, Dussehra, are called traditionally lucky for for investors, and they, at least for the Indian investors, and they keep adding gold on those days. We may see a slowdown in demand. There may be the people may still buy depending upon their pocket, depending upon their affordability. But I don't see the demand as strong as it was last year or over the last 5 years. We may see a drop down in demand by at least 22% in the current year, considering the prices hovering around 1,08,000, 1,10,000 in the domestic markets. Internationally, prices are close to all-time highs, around $3,700. So we may see a slowdown in demand in this festive season from the Indian consumers.
So, Pranav, any possible risks on the horizon, be it domestic or global, that might stifle gold's upward march? We're just getting an idea of what might be able to stop this gold train, for lack of a better term.
Technically, what the charts and have been indicating, the $37, $37.20, $37.40 seems like a good resistance in the international spot. So prices, that is what our last target too is, around those levels. So we expect at least prices moving towards there, and from there is a possibility of a small correction coming into the gold prices. But let's see how the developments happens in the international market. Also, we will, after which we would be coming towards the financial year ending in the international market also. So there also we may see some profit taking, which could be possibly coming in the month of towards late October or November, December. We may see some liquidation coming in gold prices, and we could see a round of profit taking from around $37.20, $37.40 on the upside.
So maybe a fourth quarter pause for the precious metals march upward. We'll have to wait to see if that does manifest over the next couple of months. Pranav Mer from JM Financial Services, appreciate your insights on where the precious metal is heading and what's next for gold and investors interested in the safe haven asset. Well, Indian markets have joined the trading day. We'll look at some movers in Mumbai after a short break. We'll be back in 2 minutes. You're watching Inside India. Indian markets did come online about 3 minutes ago, and nifty for the Nifty 50. They're up and extending that breach of 25,000 day, 0.25% in the green for the Mumbai benchmark today, indicating that strength, at least, in the equity space continues. The rupee, though, continues to soften in lockstep. They're down to about 88.38 against the U.S. dollar, about a tenth of a percent weaker against the greenback, continuing that trend as it tries to plumb new record lows or weakest levels on record. Let's look at some of the movers in the Indian market today. Infosys approving its largest ever share buyback. The second largest IT firm in the country will buy back shares worth over $2 billion. Infosys has set a price of 1,800 rupees per share, and the buyback will be done through the tender offer route. This is the fifth repurchase in Infosys' history and the first since 2022. Shares of Infosys also climbing today, up by about 1.4%. The broader sector, though, is starting to worry about another possible headwind from the United States. Clients are delaying contracts while U.S. lawmakers debate a proposed 25% tax on outsourcing. The so-called HIRE Act would penalize American firms that use foreign IT services. Analysts say it's unlikely to pass in its current form, but it signals a shift in how U.S. companies might buy technology services. India's top IT exporters that count the United States as one of their largest markets could all be affected. Experts warn the proposal could raise outsourcing costs by as much as 60%, squeezing margins and delaying big tech deals. And a quick check on Indian automakers. All of the major car makers announcing lowered pricing after the GST overhaul, promising to pass on benefits to the customers. The revised pricing is expected to spur demand ahead of India's busy festive season, a sentiment echoed by the big OEMs at an industry event in New Delhi. CNBC TV 18's Parikshit Luthra was on the ground and filed this report.
Here at the 65th Annual Convention of the Society of Indian Automobile Manufacturers, which is the annual gathering of top automotive CEOs in India, there is an air of optimism about the recent GST reduction. Almost all OEMs told CNBC that they are expecting sales to go up on a sustained basis. Maruti Suzuki, India's largest car maker, said that the sales of small cars will go up by at least 10%. And this was a segment that had been ailing for the last few years, especially since COVID-19. Hyundai Motors, for that matter, told us that car sales had been in negative territory in April to August this year. That is, in this fiscal. But now they expect sales to rise from near zero to about 5%. So they expect sharp growth in the coming months, especially in the festive season. Maruti Suzuki, for one, expects a 20% growth in the festival season. But a lot of the demand picture will be clear in the next few weeks. There are also pain points for the industry, such as the rare earth magnet crisis. The Tata Motors managing director, who is also the head of India's leading automotive industry association, he told us that it is still status quo as far as the rare earth magnet crisis goes. They're not getting licenses from China, and the OEMs in the country continue to find alternatives. The production has not been cut, and everything is being done to ensure the vehicle supplies in the market, especially those of electric vehicles, remain on track. The companies are also looking at the FTAs that India is signing and how to leverage them in a bigger way. Companies like MG Motor, or JSW MG Motor as it is called here in India, they expressed optimism about India-China relations and felt that strong India-China relations can really help Indian automotive companies access the right technology from China. Overall, the demand sentiment here in India is optimistic, with more money in the hands of consumers after an across-the-board GST reduction.
And let's hear now from some of the Indian car makers that Parikshit spoke to on GST cuts and EV competition with China.
GST, especially for small cars, we see the 10% reduction of the rate. Actually, it's 11% including cess. So our retail price, if we are going to transfer all the benefits to the customer, so customer will enjoy at the retail price level almost 8.5% reduction. I think that will push up the sales from current going rate to almost like a 10% increase. I see, that will happen after GST. And not only small cars, but overall, all segments will receive big benefit thanks to the GST. So I think overall, total market will see 7 or 8% increase in the next financial year.
I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42-43% in first-time buyers. So more small car selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity because India is a very, very aspirational country.
I think it is a very welcome move. The Prime Minister has taken a very progressive step in working towards bridging the gaps with China. I must acknowledge that, and I think in our path to sustainable mobility, it is important to draw on capabilities from around the world, China included. China today is by far the most significant market for new energy vehicles, and in our path to building a sustainable mobility ecosystem in India, it would augur well for us to draw on the capabilities from China while we are building our own capabilities as part of the Viksit Bharat project.
One final check of Asian markets today. It's a fun Friday for major equity indices. Go green is the call right now, with most indices, as we mentioned, most stocks reaching new highs, including that to the Nikkei 225, now trading at a new record high once again on the back of this 0.75% surge. So all smiles in Shanghai, up by about 0.25%, and we have the Hang Seng Index also getting a lift, with tech stocks outperforming the broader benchmark there. The Straits Times Index in Singapore, though, one of the laggards, perhaps some signs of profit taking after they hit a record high in a recent session. But again, as we mentioned, the Nifty 50 continuing its breach of 25,000. Whether it can contain or extend that breach will be on everyone's minds as they aim for an 8th straight day of intraday gains out in Mumbai. And that's all the time we have today on Inside India. But do keep watching CNBC. Access Middle East is up next. Have a great weekend.